Now, still with me in the studio is Nnamdi Wizu, co-managing partner at Commercial Partners, and still joining us virtually is Bismarck Rwane, CEO of Financial Derivatives and member of the Presidential Economic Advisory Council, and of course, Ige Akpata, chairman of Skymark Partners. Nnamdi, your initial comment, well, he did say a lot, but let's start with your initial comments from the central bank governor.
Yeah, first of all, 50 basis points hike. Everybody expected a hike. I guess the question was by how much. I thought that they would do a bit more than that. Like I said, I think the transmission policy needs to be looked at. So I thought that maybe they would do it by 100 basis points and try and look for other means to try and tackle inflation. 22% isn't a joke. It's a huge inflation figure for the country as a whole. Has a huge impact on the pockets of people, the lives of citizens, businesses, GDP. It's huge. It's something that needs to be tackled. It's interesting. His comment around if they hadn't tightened, that inflation would have been 30%.
For April, yes.
Yeah, I mean, it would have been good to have additional information. So, for instance, if they hadn't done 22 trillion ways and means, would we be at 22%, or would inflation be much lower than it is today, or all the various credits that we've seen in the central bank, avail to the private sector? It's also interesting to see that 10 out of 11 voted for the increase, which means they are still on track to continue to tighten. And we'll see how this plays out with regards to the increase, see what kind of effect it has on inflation. But I think that something else needs to be done. We're interested to see how the new administration handled it and what their policies will be when they come in.
Absolutely. He did point, obviously, to the fiscal authorities. Bismarck, let me bring you in here just to hear your initial reaction to the outcome of this meeting and some of the interesting comments made by the governor.
Well, I think, personally, I think that the announcements are relevant in theoretical terms. The reality is that the markets have gone beyond this meeting. The markets expected an increase. But what is more interesting to the markets is what's going to happen after May 29. So this is what we call the twilight zone. So people just sunset day, and that's all. The reality is that the hypothetical counterfactual analysis of saying that if you did not do this, then this would have happened. Then you cannot confine that to one variable. You should also tell us that if you had not done this, what would have happened to growth? What would have happened to unemployment? What would have happened to the exchange rate? So I think that analysis is good for the laboratory, but in the reality, the markets have gone beyond this particular meeting. The markets are expecting a new dispensation. The markets are expecting a new direction. The markets are expecting that we are going to be talking to our creditors about what terms and conditions they will give us to restructure our debt. That's more important than anything else. The exchange rate has already moved in the wrong direction. And you can see that even the rate of exchange for airline tickets has gone all the way to 640. So that tells you everything, that the markets have gone beyond policy making. They are now looking towards institutional reform.
Ige, I'd like to hear your comments, please.
Well, I don't think there's anything particularly surprising about what was said today. It's more of the same. I think it's interesting that it is almost unanimous in terms of the members' votes for 50 basis points. So at least 100% voted for an increase. But I think the reality is that the central bank has come to the end of what its tools can do for the market. As we're speaking, Treasury bill auction results came out, 8% on a one-year Treasury bill. So what does that tell you about how the market is dealing with negative returns over 1 year? So a lot of the transmission mechanism is broken, but we know what the real root cause of all that is. And that's the level of spending of the federal government. And unless something can be done to somewhat adjust that spending to align a bit more with revenues, you're going to keep having more of the same. The next few months will say a lot. If you have a supplementary budget, which I would expect, how will it be funded? Almost all debt. You're back into the same spiral. So the central bank's hands are tied, and most of what was said today effectively suggests that the only trick they have left is to increase rates. They can't really move the CRR much. It's already at a ridiculous level at 32.5 on paper, but effectively a lot higher. So their toolbox is more or less exhausted now, and it's up to the fiscal authorities to act under the new government to change the trajectory.
Thank you so much, Ege, for that. I mean, a lot said there, and quite spot on. And according to, and as like the governor did say, non-monetary factors beyond the reach of the monetary authorities weighing on the economy. Let's talk about where we go from here, going forward. And one question that keeps coming up, especially, and I think now would be an appropriate time, especially now that a new administration is coming in, is what kind of economy does Nigeria want to be? Yeah. Is it going to be market-driven? What should we look forward to? What are your thoughts, especially for foreign investors who are watching?
Well, first of all, definitely a market-driven economy. I think we also need to switch to become more of an exports-driven economy also than import. Because we've always been net importers, and that continues to put pressure on the currency, which invariably leads to inflation and invariably leads to tightening and all that we've seen. So we definitely need to have a situation where we tackle certain sectors of the economy head-on, right? Some hard decisions have to be taken. We have to look at a way to reduce government spending, reduce government spending on subsidy. Have to look for ways to naturally generate more revenue, try and bring in more people into the tax net, and then start to boost the manufacturing sector so that we can start to export more rather than we import, right? And that would help reduce negative balance of payments and co that we have. I think we also need to try and free the markets a bit more when it comes to the financial markets, because as it is right now, you more or less have FX markets sort of like controlled by fiat. You have the fixed income markets not trading as it should. So you have the markets a bit dysfunctional. It would be good to see those markets start to operate optimally. So, because if that happens, then it gives more confidence to investors who want to be able to come in and exit the country using the mechanics of the secondary market. And that's something that we've seen quite a bit of a disconnect over the last few years.
Right. Bismarck, let me come to you. Nnamdi made some very good points there and talk especially around investor confidence. I know obviously a lot of investors are looking in and wondering, okay, what shape is this economy going to take? I know that a lot of what we're saying here, I mean, we're just speculating. We'll have to wait for this administration to come in and actually begin to roll out those policies and see how that helps the economy take shape. But I'd like to talk about the exchange rate. That has been one area that has been quite sticky. For a couple of years, we have multiple exchange rate system at the moment. We've heard from the IMF, the World Bank, analysts such as yourself. You and I have had several conversations around this. What needs to be different now going forward in terms of what would be good for the economy and perhaps also expectations from the international community going forward?
First of all, let's know what is not good for the economy. What is not good for the economy is multiple exchange rates, because you are just creating a arbitrage paradise for arbitrageurs, right? Secondly, people who benefit from round-tripping this money continue to expand the gap between the parallel and the actual effective rates. So what needs to be done is just to have the determination to unify rates. And when you do that, it goes back to the whole question of if you want to make your economy less dependent on imports, then you have to adjust the exchange rate to make it more expensive. And when you see that, when that happens, then the difference between the parallel and the money and the nominal rates, that's your theoretical rates, official rates, will actually reduce. But having said that, that's all theory. What is important today is what are the expectations, market expectations, that policy will change, institutions will change, and that if failure to do that means that the economy itself is going to go into a tailspin. Right now, Nigeria has no choice but to do exactly the right thing and stop doing dumb things. That is precisely where we are. So for the exchange rate today, I think we're trading at about 755, 760 to the dollar. And that's against a weakening dollar. Against the pound, it's about 950 to 960. And there's no supply, either in cash or supply in terms of investment flows. I think all of this will come to an end very briefly, as soon as the directions known, as soon as we get talking to our creditors, the London Club, Paris Club, and the Washington Consensus. Once that is done, we find the exchange rate begins to find itself into a value. We believe actually the exchange rate will appreciate once you allow the official rate to move in the right direction.
Again, I'd like to bring you in here. Let's talk about debt. Now, this administration is going to be coming in with a huge debt, 77 trillion naira, debt to service revenue that's also high. Mobilizing domestic revenues has been very difficult for this the outgoing government. We know that the NNPC has said that, I mean, we've heard that it hasn't been remitting as it should to the fiscal coffers. Talk to us about how this government proceeds going forward. We know there's a supplementary budget, and we know that debt is a big problem.
Well, I think a lot depends on, this is where there's a big difference between, willingness and ability to pay. I think what is interesting is that on the campaign trail, the president-elect was the only candidate who did not talk about debt restructuring. The other three talked about restructuring a number of times. I mean, my personal opinion is that, let the sleeping dogs lie, just leave the debt where it is and just keep servicing it the way you've been servicing it. Because the implications of making any changes are very, very dramatic. So, for instance, local currency debt. See what Ghana did with their local currency debt. I don't know why they touched it. You can print your way out of the problem, tax your way out of the problem, devalue out of the problem. There's a lot of things you can do to your local currency debt. Those debt service numbers are somewhat inflated by principal repayments. In terms of interest only, which is really your cost of your debt, it's not as high as the 90, 100% people talk about. It's more like 50, 60% interest only, which is really your cost of running your debt. So on the short term, there's really no need to disturb the foreign debt. There's a repayment of $500 million Eurobond in July. That's already funded. Nothing for the next 2.5 years. And it's on the Eurobond side. Dollar debt service about $2 billion a year. You can manage that. Naira side, as I said, kick the can down the road, roll over, nothing to do there. The challenge is that there are a lot of things that seem good on the short term to do that have implications. So for instance, look at the banking system. A bank like Access Bank lost 100 billion in Ghana just from their debt restructuring. You extrapolate that into Nigeria, and a bank like that loses 2 trillion. They have no capital. The capital is wiped out. You wipe out their capital, they become useless to you. What's the implication on the economy? So there are a lot of second and other effects from some of these actions, which seem good on the short term, but until you go into them, you start to realize that you've created more problems than you solve. Short answer, you should leave the debt the way it is, but what you don't do is continue the ridiculous level of federal government spending. That doesn't solve anything. Federal government taxes are already too high. Corporate tax rate in Nigeria is 34.5% for most people. Corporate tax in the UK, I think, is 25%. US is going to 28%. So you say you want foreign investors, but you have a higher tax rate than advanced Western economies. Why would they come here? So those are the kind of structural things that need to be changed. The architecture of the government finances have to be rejigged. But for now, the debt should be left alone.
Right. All right. Thank you for that, Iggy. Let's quite an interesting take on Iggy's part. But let's talk about, also going forward, Nnamdi. Just looking at going back to the numbers from today's GDP data from the MBS, the performance of the GDP was driven primarily by the services sector, according to the MBS, posting a growth of 4.3% and contributing 57.2%. Just talking to the strength of the economy generally, we've heard the key shocks and the pain points for the economy as rolled out by the governor, declining oil production, moderate recovery of output growth, etc. So what would it take going forward? I know that this previous administration, the outgoing administration, focused on agriculture. What do you foresee being the focus of this new administration on the economy going forward?
Well, I think, first of all, they're going to have to, I mentioned it earlier on, trying to focus on manufacturing, right? If you want to be able to export, which means you need to try and get power right. And it's a good thing that recently the president signed off on a policy that allows states to generate their own power, right? So if you can get power right, then you start to see better production, right? And you can get your currency right also. Those two things are two major issues that manufacturers would have. And the question also is there a way we can export the services that we offer? If services are a big sector of the Nigeria economy, how can we export those services that we can start to more or less monetize it in dollar terms, right? So that we get more dollar flows coming into the economy. So I think if we can try and focus on those two things, right, in the short term, with new administration coming in, I think we'll start to see some changes in the performance of the economy. And I totally agree with Eggy to add that we should not talk about debt structure, in my personal view.
yet in the short term?
In the short term, we should focus on reducing interest rates and trying to increase the revenue of the country, right? So even the government spending is not even the major issue, but I think it's more of revenue generation. The informal sector is bigger than the formal sector, and the formal sector doesn't pay tax. You need to find a way to bring in the informal sector into that tax net.
Well, because that was going to be my next question, mobilizing domestic revenues. What aren't we, what haven't, in hindsight now,
Yeah.
what didn't this government do right?
Same thing I just said now, which is bringing in the informal sector.
But they tried to. We had, of course, the Finance Act, we had the tax reforms and
Yeah.
all of that. But that.
Well, so when you see the taxman, they're still going after the big companies. They're still not going after the informal sector. And it's a huge sector, like I said, even down to the gate men, the drivers who don't pay taxes. I know it sounds a bit brutal, but in developed economies, everybody pays taxes. So
Right.
how are you going to bring all these people into the tax net, expand the revenue base so that the government on its own earns a lot more and is able to service its debt?
All right, we have about 2 minutes left, Bismarck. So I'll give you you and your 1 minute each for just closing thoughts on this conversation. 60 seconds, please, Bismarck.
Well, like I said earlier, the truth is that the markets expect certain things. It's not up to us whether we agree or disagree to do anything about our debt, kick the can down the road. The reality is that what are the projections for Q3? The projections are simply this. One, growth is going to slow down further from 2.31, it's going to go further to about 1.5. The cumulative effect of the Naira redesign and some of the dumb policies that have taken place in the past. Two, that inflation is going to increase again. Why? Because the exchange rate is still in disequilibrium. And two, that there's no supply of foreign exchange into the market to increase supply. Three is that the service sector is the one that is moving fast while the real sector is declining. Oil, your oil production is down, oil theft is increasing. You got to do something about the security and the oil immediately. If you do that, then you will have higher growth, higher revenue, and then you also address the exchange rate all at the same time.
Right. Thank you so much, Bismarck. Ege?
Yeah, I think again, I mean, a lot will wait till next week. Central Bank has done its part. I'm not sure how much higher they want to move rates than where they are now. It's record levels anyway, 7% from the base last year. So I think really the next government has to tackle the big issues early. Oil theft, probably number one, between oil theft and the subsidy. If they can fix those two, then a lot of things fall in place. Revenues increase, exchange rate improves, and a number of those other things. And then they can deal with the more difficult things when they have their feet firmly on the ground.
Right.